So namaskar to all of you. Thank you all for joining on today's call. So I welcome all of you to this unique initiative taken by Aditya Birla Sun Life Mutual Fund, where we have our distributors and our fund managers get connected to each other on a monthly basis. So we have this session first Saturday of every month, and we have named it as Saathi se Samvaad, because all of you are our friends and well-wishers, and we want you all to update on what is it that our fund management team is looking at, how they are positioning their portfolio, and how prepared they are for the coming opportunities which are there. So with me today, we have Sunena D. Kuna. She is the co-CIO on the credit side of debt funds that we have at Aditya Birla Sun Life Mutual Fund. And then we have Kunal Sangoi, who is the fund manager and senior analyst, and he also manages our Digital India Fund. So welcome, Sunena. Welcome, Kunal, to this show. So Sunena, let me start with you, because I think last 2 years has been really eventful when it comes to the debt market also, and especially now the recent times also we have seen many steps taken by Fed, and then I think the monetary authorities all across the world were very busy in terms of managing the economy and rates all across. So I would request you if you can throw some light on the overall macro, global as well as India. What are your views on the credit as well as on the duration side? So that will help all of us to view the overall debt market globally as well as the domestic one.
Sure. Thanks so much, Manish, and good morning to everybody. So I'll just, you've covered a lot of points, that I have to touch on. So I'll just briefly start off with global macro. See, across the world, we are now witnessing a little bit of a moderation in the growth momentum that we had seen over the past 1 year. And this is for a variety of reasons. Number one, of course, it would be a natural slowdown after we've seen stellar growth numbers in the past few quarters, particularly with very strong consumption demand in goods across the globe. Secondly, is because of continued supply side bottlenecks that we've seen, because global supply chains have really got stretched in this entire lockdown period, in this entire pandemic period, because at different periods of times we've seen movement restrictions or lockdown restrictions in different parts of the globe. And for industries that have for a long time now moved to just-in-time manufacturing, that has resulted in issues with respect to their supply side bottlenecks and supply chains. Another reason, of course, is the Delta variant, which has swept through large parts of Europe and the US, and we're seeing a fourth wave now. And of course, the latest Omicron virus will also play its role going forward, because while it's still too early to say to what extent this virus will impact, early results and testimony is saying that it can spread quickly, but it may not be as ferocious or as virulent the way we saw Delta virus was. But the problem nowadays is with every new variant or mutation that comes about, there is an immediate reaction that most countries take. And we've seen that, in India, we've seen that as well. And particularly, us sitting in Mumbai, we've seen a lot of change in regulation with respect to, something like airline travel or school reopening, etc. So and a lot of changes keep continuously happening, and that tends to have an impact not only on confidence to some extent, but also in terms of economic activity. So these are the kind of impacts that we've seen that could have some amount of moderation on global growth. And of course, a very big factor is inflation, fueled primarily by natural gas prices, crude oil prices, as well as the commodity prices. Now, for the last couple of weeks, we've seen some amount of moderation there, and a fair amount of moderation, not only in commodity prices, but also in crude oil and to some extent in natural gas prices. But the combination of all these factors has resulted in seeing some amount of moderation in global growth. Now, if you're looking at it from an India factor and how things are going in India, Over here, growth factors and all our indicators are showing that things are steadily improving. But the only thing is that there is a little bit of a divergence in the sense that 50% of the indicators are still below our pre-COVID levels, which suggests that there is a K-shaped kind of a recovery. And this is something that we are seeing not only in results of companies, but also, we're experiencing it when we're seeing the data coming out. And what do I mean by that? The recovery has been extremely good in India, but not all sectors and not all segments have seen that recovery. There are some segments, some sectors that have seen scarring, and we believe some of that scarring may actually be permanent. Now, the RBI has been always in its commentary commenting on this, that they're looking at not only the level of growth, which is very good, but also the breadth of growth. And they will look at the breadth of growth also while deciding on the policy normalization. So that's one. Secondly, as far as inflation is concerned, headline inflation has actually moderated from the highs that we saw a couple of months ago, but it's still expected to remain at the upper end of RBI's tolerance levels. But the important thing to note is that it remains within RBI's tolerance levels, and RBI continues to think that some amount of this inflation is transitory due to the supply side constraints that are there. RBI language continues to be reasonably supportive to growth. And that's, as I said, because they're looking at the breadth of growth and not only the scale of growth, because breadth and depth are both important. But the other thing that we've seen is, and what we believe in how RBI will react going forward, they've already started on the path of normalization. And they have done that by sucking out liquidity, some amount of it through the variable rate reverse repo that they are conducting. And they will continue with their normalization. Now, markets have already priced in the normalization, of course. But markets, we believe, are overestimating the pace at which normalization will happen. So there is no question that normalization will happen and rates will go higher from here only. But the pace at which that happens is important. And we believe that markets, at least, if you look at the overnight OIS market, the OIS market is expecting rates in 1 year to go up as much as 170 basis points. Now, in our view, that's extremely sharp increase that markets are expecting from RBI, and we don't think RBI will move that sharply. However, what we do expect is that RBI will initially, they've already started by sucking out liquidity and reducing the amount of liquidity that's available in the market. But the next step, which can come as soon as December, is that they will reduce the width of the corridor, and they will start off by raising the reverse repo rate marginally 15-20 basis points for reduce that corridor, and they may start as soon as December and then going on in February, and then later on they will start off with their repo hikes, but that will also be gradual and there could be some pauses in between. So pace of normalization is the most important. Of course, everybody knows that rates will only go higher from here. When we're looking at the credit markets, and that's something that Manish also asked me to touch upon. We've seen that credit markets are actually doing extremely well when we're looking at corporate India health. And I think the results that we're seeing from corporate India, over the last few quarters have been stupendous results. Corporate India, of course, does reflect only, the top companies, and if you look at it from any perspective, these are the top large organized players. But if I look at something like, let's say, the CRISIL advance to decline or the upgrade to downgrade ratio, that in the September ending quarter actually has reached 3x, which means there are 3 times more companies being upgraded than being downgraded. And if we looked at the same ratio last year in September 2020, that was 0.5x. And as we know that, rating agencies also, have a fair amount of, rear view mirror look as well as, looking forward. But from both perspectives, you can make out that, the corporate health is actually extremely good. And that's because corporate India, the large organized players have taken advantage of the huge amount of liquidity that RBI made available to them, particularly in the initial part of the pandemic, by reducing and replacing their high-cost debt with low-cost debt, terming out their debt. So, they're now borrowing 5 years, 7 years. And bankers are chasing them because they're flush with liquidity, and they've also made use of the buoyant equity markets to actually shore up equity, repair their balance sheets, and reduce leverage. And I think no better place have you seen this than where our earlier capex intensive, high debt metals companies, particularly iron and steel, we're actually seeing huge amount of repayments happening from that sector. Of course, a lot of sectors, particularly those dependent on commodities, have seen a huge amount of expansion in margins, brought about primarily by commodity prices shooting upwards. We believe that going ahead, while commodity prices will moderate, and we've already seen some amount of moderation, margins of those companies where commodities form an input will moderate. Balance sheets are very well repaired. Profitability is extremely good. And companies in general are doing very well. Now, of course, there is a K-shaped recovery, as I spoke about earlier. So there are some companies and some sectors which are not doing well. So which are these? One amongst them would be the small unorganized players. And that is because we've seen market shares change and move from small to big and from unorganized to organized. So that's something that we've seen play out, and at the receiving end, of course, then become the small unorganized players, and you're seeing it in the NPAs of the unsecured MSMEs rising and spiking quite sharply, and that plays out through that means. And the second place where we've seen is the bottom of the pyramid. In terms of households, those have been very badly impacted because you've had sole bread earners either being unable to go to work or being out of work, or having health or worse issues during the pandemic, and as a result, that segment has been quite badly impacted. And you see that in the spike in NPA shown by the MFIs. So, we're able to see that, in terms of numbers as well. But overall, on a broader perspective, corporate India health doing extremely well. And those are, of course, the companies that we invest in. And even within that, we invest only in the investment grade companies. So, extremely good times for corporate India and corporate health going forward. Manish, with that, I will hand over back to you.
Thank you. So largely you mean to say that the unorganized space and the microfinance companies on the lending side, so there is where we still see some bit of problems or some bit of unrest that is still there. Whereas
That's right, Manish. So some amount of stress still continues over there. And of course, there's one sector, I mean, you can't really call it a sector, but one bunch of companies that are still impacted, which are the contact services. Those are the ones most impacted because of any kind of spike in a virus or any kind of restrictions in terms of lockdown. So these would be your restaurants, your spas, airlines, airports, theaters. Those kind of sectors which are high intensity contact services.
Thanks, Varuna. So, Kunal, welcome for this session. And first of all, congratulations for the stellar performance that Digital India Fund has shown. But along with that, we have also seen last 2 years, the highest capex that has happened in the technology segment, largely for technological enablement as well as upgradation. But it was again followed by this big pandemic that the entire world was struggling with. But what do you see this particular segment going forward? What are your views on the overall technology sector going forward? What are the trends that you're looking at basically?
Thanks, Manish, for having me here, and good morning to everyone. So I think, Manish, as you rightly said, so there is a huge capex activity technology enabled, which has gone over the last, say, 1.5 years. So if I have to, categorize, key themes that are coming through at this point in time and even post COVID, and whether it is, temporary or going beyond. Okay, so I'll just talk about that. So first thing we need to just, keep in mind is that what has happened because of the pandemic, there has been a huge surge in the online activity, and that is across the board. Okay, so, the pandemic has changed the way, we have in terms of our behavior patterns. Number one, the way we do our payments. That has been a big shift in terms of utility payments, etc. Right, and even peer-to-peer payment. That is one. Second is that the way, we have started working from home. So all these virtualization, virtual platforms, the whole work from home ecosystem. Okay, so that is what has changed. Third is in terms of the way, kids are given education. So, everything moved online. So there was this third, segment where, there has been a big improvement. The fourth is with regards to the, food, as in, in terms of the gaming activity and, the watching. So, when you watch online as well, so it is one is that OTT platforms, TV, as well as as well as on the gaming side, kids started spending a lot more time in terms of the gaming activity. So that has also moved online. So across the board we have seen that surge. Now, all the businesses so this is from the consumer side, that consumers saw that surge. From the business perspective, businesses were not necessarily prepared to cater to this kind of a surge in the activity. So there was a big investment in terms of the cloud adoption. So that, all these first themes that, leads to the second theme, which is, there is a big huge cloud adoption activity that is right now taking place. So over the last 1.5 year, a lot of, workloads of enterprises have started moving from on-premise towards clouds. Clouds is basically, it gives you, the faster, high reliability. It can help you in terms of the scalability, and it is faster time to market from a business perspective to, take into account. So even for this webinar, if we have to, accommodate 500 people, participants, 1,000 participants in, I think, I remember in our voyage earlier this year, we had almost like 1,800 to 2,000 participants at a point in time, right? And even higher. So cloud gives that flexibility. You did not invest in that kind of capex, but it provides you that pay as you go model. So that is the second key thing. So, and if we were to look at from a business standpoint, so there, this cloud adoption was a trend which was there even say in CY 18-19, but it was moving at a very slow pace. I think pandemic acted as a trigger, and which is why there is a big push towards it. And at this point in time, we are not even halfway through in terms of the cloud shift from on-premise towards cloud. So we are probably, I think I was looking at Gartner estimates, etc. recently. It's only 21% of the workloads which have moved to cloud. And we are yet to see almost a 50 to 60% kind of a movement that is a potential market. So from that standpoint, there is a huge, it is a structural shift that is happening. That is a second trend. The third trend, if you have to see, is that digital adoption is happening across verticals. Earlier, historically, for say, IT companies, big banking, financial services, and retail were the two largest verticals. And these two verticals were faster in terms of the technology adoption, always ahead in terms of the technology, because they have to deal with direct consumers as well as the internet and transactions, etc. Now we are seeing, that technology adoption is happening across say manufacturing segment. A lot of, IoT related automation, machine automation in the factories, etc. On the healthcare side, on the pharmaceutical side, more on the now on the telecommunications. Telecommunication capex is very lumpy. It comes every 7-8 years. Probably that time is mature. So across vertical, the technology adoption is increasing. So that is the third thing. And fourth thing is that, a lot of these technology investments into say calendar 18, calendar 19 were happening on the front end systems, which is, where the consumer is facing, be it the applications, app ecosystem, or be it your interface on the websites, etc. Now this, enablement is happening at the core systems. when it happens at the core systems, your core systems have to talk to the front end systems because of the huge surge in the activity. They have to be enabled. So these take huge amount of time, as well as these are large, long duration projects. So from a standpoint of technology, capex, or I think we would say that there is at least a 2 to 3 year runway in terms of the higher growth that we could see from here as well. So that is how I would summarize the third thing. That is the third thing. Fourth, I think big theme that is post COVID that we've seen is that the rise of the consumer internet in India. That is India specific. So where we are seeing consumer, the number of transacting consumers has surged, and that surge is leading to a lot of new business models in India. And these business models which were in the private market are probably to an extent now coming into the public markets. And we as investors of public markets have started getting that opportunity to invest in those new age. So the whole new business model, be it in terms of food delivery, be it in terms of ride hailing, be it in terms of education, be it in terms of fintech, the whole new fintech. So all these are various themes. I think they are, and this consumer internet, I think as a theme, it is a long runway. It is just scratching the surface. So I think from a full decade perspective, I think we will see the whole digital decade in a way. I can put it that way, that India's digital decade is just starting through.
So in that case, I think technology or digital has become the new and very important family member in all the family as well as in the offices, and this is going to remain for a long time. And this is I think going to change the way we do things, change the way we look at multiple things. So thanks Kunal for this. So Sunaina, let me come back to you. Recently, we have seen that SEBI has in fact issued one regulations in terms of PRC, that is I think potential risk class matrix, and I think which all the AMCs have adhered to from December 1st. But I think when we had done this, there was mixed view and reactions that came from investors as well as distributors. So I thought ये एक अच्छा platform होगा हम सब के लिए to understand कि what does this mean for the investor, for the distribution, and how does this going to impact the investment and the investment process overall. So if you can just throw some light on ये process का क्या मतलब है, इसे कैसा लेना चाहिए, is there anything to fear, or is there some positive thing that is to be taken from this?
So Manish, actually this entire exercise that SEBI has asked all fund houses to do is just an expression of the existing funds. What is the tolerance of risk on both matrix, on credit as well as on duration? It is going one step forward from what we had earlier, which was the color categorization, if you remember. So, so this is just to give more information, more awareness to the investor so that they understand what kind, when I invest in this particular fund, what does it mean in terms of risk? So earlier, SEBI had suggested this color categorization, and as you know, all funds were had categorized their various schemes, and each individual fund had a color coding. Now they've gone one step further and said, okay, for debt funds, you have two primary risks: credit as well as duration. Please tell us on a 3x3, so 3x3 table, so in a 9-box grid, where the fund can maximum be. Okay, and let's say, so as a result, every fund house for each of their schemes has categorized their schemes, or not categorized, has put out over there where in the 9 grid or this 3x3 grid on 2 axes of credit and duration where their schemes are. So it is just additional information to investors to help in their decision process that, okay, this is a fixed income scheme. It's a liquid fund, let's say, for example. So this is its color categorization. It's a liquid fund. We know as per regulation what the duration is. But let's say in terms of credit, to what extent is the fund manager taking risk? What is his or her maximum risk that they will tell. And that is where this 3x3 grid helps. That tells you that where they are on the credit plus duration scale. So it's just additional information being given to investors, taking it one step forward. And actually, it's very good in terms of what SEBI is doing. That more and more information is made available to investors and distributors so that they can take an informed decision at the time of taking investment, that they know that okay, the portfolio may be this, but this is the maximum risk that the fund manager is expressing his or her view that they will want to take, both on credit scale as well as on duration scale. Because don't forget, in debt, as far as our regulation is concerned, lot of our funds are regulated on duration side. Some are regulated on credit side. But through this matrix, the fund manager puts out, and the fund house puts out their view to what extent they will take on both the parameters. Okay, so this is only an expression of your tolerance level on both the credit as well as on the duration aspect. Now, one question you asked is that, and I think I've been getting this question since a couple of days, since fund houses have been emailing and messaging everybody, is that will you have to change your portfolio? How does portfolio positioning change? It doesn't change at all. Absolutely no change. I'm only informing you of my tolerance level. That means the maximum level I will go to, both on credit as well as on duration. That is all I am informing you and telling you about. I'm giving you more information about my fund. But obviously, if that is my maximum tolerance, I am already within that space. Right? This is just additional information being given to you. Over and above that, so right now the tolerance levels have been defined, but of course things are not static in nature. Over and above that, at any point of time, if let's say market changes or view changes, in case there is a change in portfolio, that also then needs to be given to investors and informed to investors that okay, this is the new tolerance. It could be higher risk, it could be lower risk. But that change can also be then informed to investors at a different point of time. So this is only additional information being given to investors on the maximum risk that the fund house intends to take in these individual schemes, on both the risks of credit as well as on duration.
Okay, so rather this is an initiative in terms of get the investor to get more informed and also not get surprises for his investment. So that is, I think, a very good step taken by SEBI. And thanks Sunena for covering that. So Kunal, let me again get back to you. Recently, we have seen lots of new startups, new companies getting on the listing space. And we as an AMC also, in last 8 months, we have participated almost in 36 such IPOs, of which more than 30 have given us positive returns. And again, good to share that the top 2 say IPOs which has given the best returns were Happiest Minds and Root Mobile. And fortunately, these 2 are still part of your portfolio. So I would just like to get an understanding, and I think ये हमारे सारे जितने भी participants हैं, सबके लिए ये एक अच्छा एक view होगा, because आज सब लोगों के पास इतनी information आ रहे हैं regarding IPOs, new startups, companies getting listed. So how do we look at this entire IPO space, especially pertaining to this digital, because there is where we are seeing the maximum companies getting listed. So if you can just share your views on that.
Versus the past. So, in my initial response, I did mention that, now their investable opportunity for, is going to widen far more as companies. So earlier, if you look at our investment in the, we have been one of the early investors in a lot of these internet names. So, that time, I think, only a handful of names like InfoEdge, Just Dial, then, there were IndiaMart and Affle, those kind of names were listed earlier. There we participated, we continue to hold, some of these names over there. Now with, more and more new age companies coming for listings, I think, the way to, look at is that, see, these are all tech driven businesses. And in terms of, the pure financial metrics, I think it may not have evolved so far. Because these are just scratching the surface. These are they are subscale in their segment. So the way to look at it, the way I would look at it is that, okay, that, what is the kind of value gap that this business is trying to fill in terms of, so when we take example of, say, Zomato, which is one of our investments, which is done well, doubled, we still hold. So what do we see? So we used to play in, Zomato through InfoEdge investment, because, Policy Bazaar as well as Zomato were the key investments of InfoEdge, which actually drove a lot of value. Now, given that, we have an opportunity to play it directly, we are playing it directly. The key value gap over here. So there are, if you look at food delivery, so there are 2-3 things which are different than, other internet names in food delivery. One is that this market is a little more advanced and evolved. So this food delivery segment has already gone through market consolidation. So if you look at probably 4 to 5 years back, there were few more players, like, say, a Food Panda, there was a Tiny Owl, those Uber Eats was there, right? And then Zomato and Swiggy, 5-6 players were there. Now, if you look at current point in time, there are only 2 players, Swiggy and Zomato, essentially. So point number one is that the market has consolidated. It is slightly higher in terms of the advanced stage. So the unit economics has started to improve. So if you look at last year onwards, they've started charging for delivery, which is 40 rupees. And now it has been an accepted norm that, both of them, they are charging. पहले discount, पहले सब discount होता था, zero marginal cost, right? Now this is established. So unit economics is improved. And so Zomato as of now has almost 60 million active users, around 14 million users, they order at least once a month. And the average ordering is like 2 times to 3 times per month on an active basis. I think one is that the width will go up. So the way to look at it is that there is a certain convenience factor that, they are providing in terms of, being at home and, getting delivered. So there is a value gap which was there, rather than physically going to the restaurant and, having food, etc. Or, there was no means to get actually delivery at home except if the restaurant delivered, right? So there is a value gap that this business was trying to, follow, actually to capture that. And the business, in terms of, factors that one should look at, is that as a category, what is the kind of opportunity size? So because, financial matrices are not necessarily available. One is that you look at the various key KPIs in terms of, the category growth, what is the total market share that, that these guys can try and take, and how the unit economics evolves. Okay, because these are slightly dynamic businesses, and, business strategies will change at various points in time. So one has to look at those KPIs a lot more closer versus, say, I would say the financial matrices, like, the operating profit and the PAT, etc. So total addressable opportunity size, the market share that, these guys can develop, can get. Third is that the key proposition is that the value gap that they are trying to fill as a business, and whether that, there is a potential to take that away. And I think the fourth most important is that whether the management is dynamic to realize that, if at an early stage, that strategy is not successful, are they able to, pull back on that strategy and move to the next and try and see? Because there could be, smaller companies where there will be some trial and error, etc. Right? So, companies like, say, if I probably at one point in time, so say Zomato only, I think it started in 2010, but I think in 2016, 17, if I remember the year correctly, they were purely a menu discovery platform, right? They started as a foodiebay.com. They only had menus of various restaurants. You had to discover that. 2016, Swiggy was the first one to start food delivery. Now, the Zomato management realized quickly that, if they don't go to the food delivery, probably they will be left out as a platform. I think they took that step, they went ahead. So I think, that was a key thing that, even if you're late, because, these are all early markets, as in, the markets are at very early stage. So if you're able to change the strategy and execute on that strategy, deliver on that strategy, then that company can be a winner. So I think I would look at those factors a lot more versus the operating profit and net profit, etc. Because unit economics, if those are coming through with scale, the profitability will also come. So I think that is how I would look at it.
Okay. So, so there are also some views, Kunal, regarding especially the listing. So few people have views on the overall valuations of these companies. Many also have view that many of the say firms, they actually plan their exits with all such listing. And we have also seen one big event, especially this Paytm event. So I think people have queries. We have seen some questions also coming on that space. If you can just throw a bit more light on overall this valuation game, the say exit that happens, and how do we look at this space also? So how cautious we are on this?
See, if you look at in the past, since we, given our background of able to understand the internet businesses better and being participant, creating value out of some of these investments, they have been fairly strong. And if you look at companies like even Just Dial, which may not have scaled up, but for us last year we used to own 5% of the company at 300-350 rupees. And recently when Jio bought over, we almost liquidated all our investment at 1022 in the open offer, right? So we've been able to create value there as well. In a lot of these businesses, when we're talking about PE exit, so it may not necessarily be right to generalize it, because say for example, Zomato, which was the first big tech IPO, right? 100 more or less, full IPO was primary. So all the money, almost $1 billion that they raised, went into the company. I think $50 million was the kind of OFS which happened to InfoEdge. InfoEdge sold $50 million worth of stock. That was the only. So PEs are still invested. A lot of companies, while, because they believe on the long-term growth prospects about the market, the PE investors continue to hold. As far as valuation, so in Zomato, of course, we found that at that point in time, value is fairly good, and there is a huge opportunity, dynamic management. So we invested. We've almost doubled our money. 76 was the IPO price. If you look at some of the other IPOs like Root Mobile, you said, right? Root Mobile on the communication platform as a service, CPaaS side, we did. That was, I think, it has been almost a 5.5, 6 bagger for us. In terms of 350 was the IPO price, currently we're still holding on. Happiest Mind, similar way, right? So, all these were not necessarily PE exits. So that is point number one. There were opportunity to make money, which we have very much made, and we continue to play that opportunity. As far as, Paytm is concerned, okay, now coming to Paytm. See, Paytm has come a long way when you look at from purely a digital wallet. It used to be a digital wallet. Now it is towards an integrated payment ecosystem. Now we need to understand that from here, what is the next stage of growth? So the growth will be led by financial services, particularly the seamless credit technology of the products to consumers and merchants. So two sides, they cater to consumers as well as merchants. So they already have huge base of merchants. They, I think, have almost 22-23 million active merchants on their platform. If you look at the number of transacting users, almost 120 million transacting users that they have, right? So that is a huge base of merchants as well as your consumer, whom you can leverage on the next financial services. So the market opportunity is huge. Now, as far as benchmark of valuations, etc., are concerned, I think a lot of these companies get benchmarked to the global peers. How system, because US market or Chinese market, they are evolved, they are ahead of us in terms of the penetration, the market evolution. So we would look at some of the global fintechs and payment companies, and in the Indian context we would customize it according to what are the changes, etc. So if you look at IPO price of Paytm, etc., was almost like 15 times FY24 price to sales basis. And some of the globally successful companies, if you see, like say Square, which is a US, Eden or PayPal, they have 80 to $100 billion of market capitalization, which actually says that there is a huge potential if the execution scale up of the fintechs happen strongly. In India, this fintech is at a very nascent stage. and it will take some time for market also to understand the potential of each of the businesses. So I would not necessarily, judge the, immediate listing and listing post listing as the success of the IPO, because, to the extent I would say, as in, company in terms of delivering the performance, I think they, time will show the kind of performance that, companies deliver, and accordingly I think market will reevaluate and rebalance at every opportune time. We've seen, companies going down, but then, they have seen value creation over a period of time as well. So I would say, and, so that would be one, but others, if you see some of the other investments, so the recent one on the technology / digital side was a Latent View. Latent View, which is a data analytics company. So we had a good investment in, Digital India Fund as well. We took an anchor position as well. The kind of market valuation, market has valued, that has become almost, almost 3 times from the IPO price that is the most recent IPO that we participated. So I think there will be, market short-term, market recognition, but the success of the company may not necessarily be determined by immediate, listing values.
So Nina, last month we had seen Fed doing the tapering. They started tapering, and global inflation is one big concern which everybody is looking at. Now, we also have got one question regarding your views on the floating rate fund as a category, and how do you see this rate cycle to evolve in the coming times? Will inflation actually force or push the governments to take call on rates, or they will still manage? And do you still feel that it is still the supply side inflation, or it is actual inflation that is coming up?
So let's separate US and India. You mentioned the Fed, so I'll talk about them first. Yes, they have announced their tapering plan. And as per, if you do a back calculation of their announcement as to how much they were going to taper, they're likely to end by June next year in terms of tapering. And I think Powell in the past has categorically said that only once tapering is completed, will they then start on their rate hike cycle. Now, of course, in the last 1 week in his congressional hearings, we are hearing some slightly different language, and that's because of persistent inflation. While of course Fed has been maintaining that it's transitory, etc., their inflation is running extremely high versus their tolerance levels. 6% versus 2%. That's the kind of, gap that is there. And of course, he has put it down to being transitory, supply side led inflation, etc. But there are a lot of, at least in our opinion, sticky variables that are not going to come down much soon. And hence, probably that is the reason why we have seen some amount of, maybe a little bit of discussion amongst themselves as to, whether they should taper faster, etc. But I think, that pertains to the US, markets. After his statements, on that, we have seen, what I was talking about earlier in terms of additional indicators and additional data coming out, which is showing that growth is moderating. So that is one thing. And, we saw job numbers yesterday. So that is one thing that is coming out from US, which is showing moderation of growth, which is what we also expect. And the second thing is, of course, as I said, because of Omicron, we have seen, crude prices cool off quite a bit. OPEC has, maintained that they will continue their pace of increase of production. And we have seen commodity prices over the last couple of weeks cool off reasonably well. So, all this is something that the US will probably discuss and decide and debate about, and Fed will decide and debate about. But yes, their inflation is running at much higher levels as compared to their stated tolerance level. They have put it down to transitory and supply side, but that is something that they will always have at the back of their heads. And particularly crude prices are politically fairly sensitive in the US. Now, coming to India, as I said, governor will look at a couple of things, and the MPC will look at a couple of things. One is in terms of growth, the fact that it is not as broad-based as they would like it to be. Secondly is our inflation, while on the higher side, is well within the RBI tolerance levels. So, in terms of normalization, of course, RBI has already started on its normalization path and it's going to continue. But the pace of normalization is not probably going to be as much as what the markets have already priced in. And the markets have already priced in a very steep pace of normalization. As I said, 170 bips hike over the next 1 year is what is already priced in, which is making our rate curves extremely steep. Now on your question on floater, very strong case for fixed income investors to benefit from the steep curves, and there's a fair amount of compensation, or if you would like, insurance for investors who can be patient in these funds, patiently invested in these funds, to benefit from the steep curve and the accrual that it offers, in the face of a normalization, by matching their investment horizon with the potential or with the duration that the respective scheme or the investment scheme actually runs. So they need to ensure that they marry their investment horizon with the duration of the fund, and hence they will be able to benefit from the steepness in the curve. Now, floater and banking and PSU funds are running like a quasi passive kind of a roll down strategy, which attempts to benefit from the same. So, to that extent, that is something that you should look at. If you're looking at a slightly longer term horizon, let's say, got an investment horizon of 3 years plus, then our SDL curves are looking extremely good and attractive because they remain fairly elevated at even up to the 6-year point, and hence they offer a very attractive opportunity for our investors. Again, we have our government securities fund, which is running a fairly high SDL allocation of about as well as our SDL and PSU ETF funds. So those will be able to benefit from this. So just to sum up, floater and short-term funds would probably continue to be the best risk-adjusted place for fixed income investors who are looking for accrual returns. Particularly when they're looking at the shorter end of the spectrum. If they're looking at the longer end, 3 years plus, then credit risk fund is something that investors should look at. But they need to keep in mind that there is credit risk embedded in a credit risk fund, and of course the accompanying volatility that can potentially be there.
So Kudal, so one of our say participants has actually posted a very interesting question that I think recently Uday Kotak has given a statement where he mentioned, I think yesterday he has mentioned that digital payments platform can disturb traditional banking and NBFC businesses. So if you can throw some light. And one more similar question was largely on like textile companies are posting extraordinary numbers, but why most fund houses shy away from investing in textile companies, but are very happily investing into Zomato and Paytm type of companies. So these two things, if you can just cover.
Yeah. So, taking, second question first, okay, say that textile companies, etc. So I think, in terms of our investments also, if you see, we have, participated in some of this uptick in the textile purely because, our view of the textile industry has been positive. So, some of our other schemes may not necessarily be, we were talking about a lot more digital and, in terms of the key theme of which are durable theme over the say next 5 to 7 years and 10 years, so which is what we are talking about. But even textile companies did offer good opportunity and we participated there. Okay, taking the first question as far as Mr. Kotak's statement, I think so certainly there is a difference that all these fintechs have started to make, and the primary reason has been that the UPI platform, it's a very unique platform, and that has enabled life, it has made life so simple for these digital platforms. Earlier, if you look at traditional banks, traditional banking, still, you know, a lot of banks are not necessarily, you know, up to mark in terms of the technology, the user interface. When you have to do, you know, online transaction, there are struggles that we face because of the UPI platform, and, you know, companies like, you know, who have, you know, UPI enabled payment platforms, be it your Google Pay, Phone Pay, Paytm, all these companies, they have made life so simple. In terms of 3 clicks, 4 clicks, you know, you are able to, you know, complete a transaction. And that is what, you know, this day, you know, the whole new generation, the generation Z, which are, you know, digital consumers, they don't, you know, they will actually, you know, you take them to one of the public sector banks website and, you know, try to do the online transaction. They will say that, you know, leave that, you try and do this, you know, I cannot do that. You know, it will be, so the whole new generation has to have, so there has to be an evolution in terms of the enablement and, you know, the user interface, which is very important. So with 3 clicks, so, you know, these days, you know, when you're looking at even broking platforms, you know, so those, why, you know, there has been a significant participation, you know, by the retail also so much directly into the broking, etc., because the ease of use. So these interfaces are so simple that 2 clicks, 3 clicks, and, you know, the transaction is done. And which is exactly that reason why traditional banks who do not upgrade their systems to, you know, compete with some of these fintechs will see disturbances. And fintechs, the first thing was that, you know, to have that payment system, payment ecosystem, which they've done. But, you know, in payments, because UPI is free as of now, they don't make money. So the natural extension of the business model of these fintechs is going to be in the you know, lending side, which is a big opportunity, investing side, wealth management side, right? So all these areas are the natural extension of these fintechs, and globally this way is where the businesses have evolved. So if banks do not keep up to that, I think certainly it disturbs that model. And, you know, as fintech start, because they have the whole, say for example, if you are a merchant, so a Bharat Pay or a Phone Pay or a Paytm merchant, you know, that merchant, the whole cash flow of the daily activity is known, of whatever digital payments, right? So probably some of these fintechs have much more information than access than what, say, our traditional bank would have, and that enables them to provide a lot more credit, or, you know, to provide credit to that merchant, versus a bank who will go by the, you know, various returns and, you know, the income statements and those things. Here, depending on the cash flow, inflow, outflow, etc., here the merchant, as in the fintechs, are able to, you know, do that 25,000, 40,000 kind of a lending to them and get a good ROI on that. So, which is why, you know, it can disturb if this scales up, and which is why, you know, these kind of statements where banks have to, you know, step up their game. They cannot have, you know, technology being a challenge or being a hurdle to this kind of growth.
Thanks, Kunal. So, in fact, one more question. I don't know whether you'll be taking any stock-specific question, but one question from Mr. Keval Jeti is that BSE is one of the oldest platform if you're considering Paytm as good platform. So, what stops us from having BSE in our portfolio?
So, don't want to talk about individual stock, but if you see our investments, I think across the board, wherever we found value from a platform perspective, we've been able to capture that, and we have always invested. So I think, you know, when we are talking about, you know, some of the fintechs, etc., we didn't speak about, say, Policy Bazaar or, you know, Nika, you know, which is on the commerce side. But, you know, Policy Bazaar also as a platform, pure classic discovery platform, which was, you know, one of the earlier business models that, you know, through InfoEdge also we played. And, you know, as a listings play, we played, say, Just Dial, which was a classic classifieds play, which solves the problem on, and, you know, InfoEdge also has on the real estate, those 3 segments. So platform related plays we've always played, and, you know, wherever we found opportunity. So, you know, don't want to talk about that.
Yeah, sure. So, Sunaina, one question that I see, and there is where I'll frame my questions also on that, is that what is the credit growth of bank currently? What is the credit growth currently, and what is the expectation going forward? And similarly, just to add to this question, as we are talking about a huge capex cycle that is yet to come in this decade. Definitely banks have geared up in terms of big credit pull that is happening, that is going to happen. But how do you see this entire credit offtake to happen on the bond market per se? Do you see even the bond issuance getting in the higher pace? And what is the, say, comparative growth that you see on the bond market compared to the normal banking credit growth? So if you can just throw some light on that.
Sure, thanks, Manish. So, let's start on the credit growth and what we expect actually. So it's running around about 6%, fairly tepid. But we expect this to pick up, and already, early signs, early commentary that we're hearing on ground from, the last couple of months is showing, not last couple of months, maybe last 2 months, and of course that includes the Diwali period, is showing that, credit growth is picking up. And that was expected to happen. Now, as far as CapEx is concerned, see, corporate India is currently operating at just about under 70% of capacity utilization. CapEx most likely will start they will start announcing their CapEx plans, and they will put them into place once it reaches, north of 75% at least, which will probably happen in a couple of quarters' time. So while there is a fair amount of growth, companies have seen a huge recovery in terms of them actually starting, looking at expansion. It may take, in terms of because of the capacity utilization still having some amount of space, they may take maybe a couple of quarters. So that CapEx cycle will probably pick up dramatically in the next couple of quarters and not right away. As far as the flows that we're seeing in terms of issuances, a fair large amount is coming into capital markets, and as I mentioned earlier, people are taking advantage of the huge reduction in interest rates that we've seen and the prevailing low rates to actually refinance existing debt. So that's a continuous process, and that comes to the bond markets. Now, you made this you're asking the difference between bank growth and I guess capital markets or mutual funds. But believe me, everybody is participating even in the bond market. So bankers are participating in the bond market as well, and they are participating in a fair amount of issuances that are happening. Of course, the larger corporates now do have a requirement that they need to, for the incremental borrowing, they need to tap the bond markets for some percentage. RBI has given that guidance. And so we will continue to see a fair amount of good supply, good quality supply coming into the bond markets. On the infra space, actually, we've already seen a fair amount. So we've already, I think, one of the rating agencies the other day put out a note as to the quantum of HAM projects you will actually see coming online, and by online they mean get fully constructed, receive their first annuity, and these are HAM roads, in the hybrid annuity model, where the annuity comes in from NHAI. You have a very large quantum actually coming for refinance in the next couple of years. And that will all hit the bond markets. You will, of course, have participation from banks as well as from market participants like ourselves, the same way that we've seen. But there will be a fairly good supply of good quality issuance actually coming into markets. And then, of course, you have InvITs, REITs, a large thrust that is being given on the renewables. So you're seeing a fair amount of that coming. A lot of these platforms coming up. And, with the development of our corporate bonds and allowing InvITs and REITs, and we've seen them, being introduced and, taking shape and actually growing. You're going to see a large number of platforms actually coming up through these various forums, and you will see a fair amount of issuance coming up there as well. So you will see, a lot of issuance coming across the board. And then, of course, in terms of sector finance, is a natural and a very the obvious borrower that comes to the market. So you will see across sectors, a lot of issuances there for the picking, both in terms of credit as in terms of credit, as well as in terms of higher rated AAAs coming as well. And you'll see it across banks, across capital markets, these issuances will be there.
So in that case, you feel the environment is conducive now for people to start considering the credit category funds. And before I end and you take this question, also, first of all, I would like to congratulate you and entire team in terms of the recovery that we had seen on this ITES, the education asset of ILNFS, where we were able to get entire principal as well as the interest money paid back. But still, there are few more papers which there are certain uncertainties which, if you can just cover up, especially ITNL, Jharkhand road projects, and Adilink, the one paper which is into segregation. If you can just throw a light on this, and also if you can give a confidence on the current credit environment, whether the time has come for people to start considering this category.
So just a clarification, we don't have exposure to ITNL, but I think what you meant was ILNFS Tamil Nadu Power.
Tamil Nadu Power, yeah.
Yeah. So let me start off with that because there's a good news in that. On this forum, many times I have been explaining that our restructuring plan is in place. It has been agreed to not only by the 16 lenders, but also by ILNFS. And of course, by Ministry of Corporate Affairs, who oversees through the board ILNFS, and all the stakeholders. But it had gone to court for approval. This being an ILNFS company, in normal course of events, you wouldn't have had to go to court. But on 3rd of January 2021, ILNFS had applied to the court for approval of the restructuring plan. It was an operational approval, frankly. We have just received this on the 1st of December. So now the restructuring has been approved by court. And we are now, all the lenders are now going to document the agreed restructuring plan, and, the implementation of that will start. So that's one very good news that has come in terms of ILNFS Tamil Nadu Power. The power plant has been performing reasonably okay. And it has received a fair amount of its receivables from the DISCOM via this Atmanirbhar package. So it is sitting on a fair amount of cash as well. So that, restructuring, which was agreed to, I think in November 2020, will now get implemented. And it will get implemented, and then cash flows will start moving back to the lenders. So that's one update on ILNFS Tamil Nadu Power. As far as Jharkhand roads is concerned, as you know, it's a green asset, and hence in the ILNFS scheme of things, it pays all its lenders and its creditors. However, the lenders had given a moratorium to Jharkhand roads, the SPV, because the Jharkhand government had been facing financial issues due to COVID pandemic and the financial strain that it had placed on the state government, just like all other state governments. So taking advantage, of the KV Kamath guidelines on giving moratorium to COVID-related stressed assets, we had done the same for Jharkhand roads, and we had given them a moratorium. With the Delta wave also now behind us, we hope that we are able to receive our annuities, and our repayments will start before the moratorium period actually ends. So, that's as far as Jharkhand roads is concerned. As far as Adilink is concerned, we are working on both the fronts. One is to sell the individual underlying roads, and the other one is to sell the NCD itself. Our investment bankers are working, the ones we have appointed are working on both the strategies with investors. And, as the economy improves, investors want to see stability. They want to see stability in terms of tolls. They want to see stability in terms of receipt of annuity. So this has taken much, much longer than what was anticipated. A lot of things are not in control in terms of timelines. I mean, I gave you I spoke about the court approval that was required, which was more operational in nature, taking actually, a good 11 months. So these kind of things, push back in our expected timelines. So, but Adilink is one asset where, timelines is very difficult to give because, any kind of uncertainty pushes back this. And, this is one sector which was badly impacted due to COVID because, tolls were completely stopped for 2 or 3 months last year when there was a full lockdown. And with a lot of, restriction in terms of interstate movement, intra-state movement at various periods of time with spikes in virus in various places, tolls have been impacted. So, and these are things not in control. So these things actually, it takes a fair amount of time. So, but our bankers are working on the dual approach, both in terms of selling the underlying asset as well as in terms of selling the NCD. So that's the approach that we are taking there. As far as credit risk fund is concerned, and you asked, whether this is the time to actually look at a credit, I would say that, given the fact that the general interest rate regime and environment in India is fairly low, just like the rest of the world. And if you look at the real return, it's, it's marginal, it's fairly low. But it's positive, unlike, let's say, the rest of the world or the developed world, where it's hugely negative and you've got negative real rates going on. But generically speaking, there is financial repression happening the world over. And that's because, central bankers are trying to force and push savings from savers into the hands of borrowers and incentivize the borrowers to actually use the low interest rate regime to go and invest, increase the capex, and hence, restart the engine of growth. And that's, what we're seeing the world over. But how do you, in a low interest rate regime, it's the accrual that you can look at, which, you can earn through something like a credit risk fund. You take advantage of that spread that is there between, let's say, a AA and a AAA, or going down the rating ladder a little bit to try and earn that spread in this period of time. So accrual returns is something that, is reasonably good in a credit risk fund and, in our credit risk fund as well. And, that's something that, can be looked at this point of time. Secondly, as I mentioned, corporate credit health is in an extremely good position right now. Our organized large companies have really benefit is probably not a good word to use given the extreme pain that has been felt, but they have benefited from what has happened over the last 2 years, both in terms of their balance sheets, which are now extremely well placed, low levered, low cost debt, lot of liquidity, as well as in terms of their P&Ls, because they have been the beneficiaries and they have hugely benefited in terms of increased margins and in terms of increased market shares, which have come at the expense of the smaller unorganized guys. So corporate India is extremely well placed. Health is extremely good right now, and then to look at this at this point of time, participate in the upgrade cycle, is something that investors can look to do, in a credit risk fund.
Okay, so our credit risk fund is already open for subscription. Do you also see in the coming times we will open up medium-term plan as well for fresh investments?
So Manish, the idea of closing for fresh purchase, our 2 schemes last year was that there was a fair amount of what we believed unresolved, undervalued papers in those funds, and we wanted our existing investors to benefit from it. It's only post IETS resolution that we actually opened the credit risk fund. Medium-term plan still has a fair amount of assets where we believe that once resolution happens, our existing investors will be able to benefit from. Which is why maybe for a little while longer we will wait for some of that to, get resolved, and then we will definitely open that up as well. But, the idea of keeping it, letting the existing investors benefit from, the the resolutions that happened, and that was the key aim for actually keeping the plan closed for fresh purchases.
Okay, and along with this, Sunana, if you can also cover, I think, although SEBI has mandated this new regulations currently, but I think we as an AMC, we all had already done one binding constraint within our own framework. So if you can just cover broadly on what that binding constraint means and how that will be giving so much of comfort to our distribution as well as investor while considering our funds. Yeah.
Sure. So Manish, the binding constraints is something that we had instituted about 2-3 years ago. And I think we publicly put it out to our investors, 18-24 months ago, that these were the constraints that we were self-imposing scheme-wise. And it addressed, on the basis of credit and on the basis of duration. You have three, levers in fixed income: credit, duration, and liquidity. So, on these two parameters, we had self-imposed these constraints. So, from a credit perspective, what is it? It is issuer-wise, the kind of exposure that you can take in a particular scheme, basis its rating and its parentage. So we have self-imposed tighter than the SEBI regulation. What will be the issuer-wise exposure? What will be the group-wise exposure? Also, we have formulated a minimum rating threshold that we will take for a particular scheme. That means, in certain schemes, we will not go below, let's say, AA. In certain schemes, we won't go below AA plus, for a single issuance. Although, of course, the SID allows you to do that, SEBI allows you to do that, because SEBI allows you to invest in investment grade papers. But, we self-impose that kind of discipline that, although something may look attractive, we won't go down, the credit curve in certain funds. So investors are also well aware of what they are getting and what kind of credit risk they're buying into. So that was that. And also in terms of the overall, rating profile of the fund, what kind of rating profile we would see in certain funds. So each fund is, gives this kind of self-imposed binding constraint. So this is in terms of the credit piece. In terms of the duration piece, similar, what kind of duration that we will play within the SEBI mandate of regulation for that particular category of scheme. In certain schemes where there is no, let's say, upper threshold, we have put in internal upper thresholds as to what kind of duration we will run, and also the maximum tenor of papers that we will take in certain schemes. So that way, these are all self-imposed binding constraints, as we call it, and that's the parlance that we use. These are the binding constraints that we have created for each and every one of our schemes on both these parameters, credit as well as duration.
Thanks, Sunana, for this. So Kunal, let me come back to you. So again, as we were discussing about the stellar performance that Digital India Fund has given. If you look at last 1.5 years, it has grown 6x times. So that itself talks a lot about the way fund has actually grown. So I would just want to get an understanding from you that within this entire digital space, if you look at this digital space, again, this is evolving. And previously, we only used to have the software companies. Then all this mobile handset manufacturing came in, the platforms, many companies which make platforms. Then we had that artificial intelligence, food delivery, automation. So multiple things are happening within this space. And I think this is one of the most eventful and heated space. How do you actually look at this space? What are your thought process when you look at any particular category, whether to say get into that space? How do you analyze that sector or that particular stock? If you can just throw light on this, and what is your view and expectation going forward from this fund also? So that would be great.
Many questions in one question. So, with regards to the thought process, okay, if you look at the fund positioning and the, what is the investable universe for this fund. So it is essentially, not just, technology, it is as in, IT services, plus telecom, plus media, plus platform companies, plus some of the outsourcing as in business services, which is, manpower outsourcing, etc., those kind of services. So the slightly universe wider than purely just IT. That is point number one. Second point is that, since last 2 years, 2.5 years, we've started doing international investment also. So some of the technology companies which, were gaining good market share or, had good prospects, we could get and, try and participate in that as well. So, among the current investments in technology, we have up to, 5 to 6% kind of investments in overseas tech companies. And couple of these companies like Microsoft is one of the investments that has already been more than 2x for us in terms of the investment value itself. Apple is the second, that has been almost 3x for us from the first investment that time. It is quite, so one is so one was so it is, one is that from a investable universe, these are the investable universe. Now second point is that last 1.5 to 2 years back, we post the pandemic, we took a conscious call that there is a lot more opportunity to invest in Indian IT companies. Okay, because of the all the lockdowns, etc. Then there is going to be always a push. So one of the things is that if you look at IT sector as a sector itself, 10 years back, 20 years back, I think, post 2010, post 2000 actually, Y2K boom, a lot of, people said that, this sector ka best part of the story or sector, best years of the sector is done with. Post .com bubble, mein, right? Post .com bubble, ke bhai best is over for the sector. But what we've always seen is that, these IT businesses are super cash flow businesses. They are just about 20% of the addressable market, global market as of now in terms of value. In terms of volumes, we are probably at about 30 to 33% of the global market. So there is a huge headroom still, okay, from IT companies perspective. So from a growth perspective, these companies can do well. And hence, we said that, when the stocks had corrected, we would try and increase our exposure in the mid cap and small cap segment, where the valuation was, mouth watering. So some of the investments that we were able to, capture that time were at, very, low entry points. And, fortunately, those did work in our favor. And some of these stocks have done phenomenally well for us. So one is that we increased so our orientation is that we would go after, some of the value driven stocks, which can give, higher delta. And, value is always when, the outlook is not so favorable. And that is the most important time when, if the business wise, you take a call that over the next 2 years, 3 years, the value will eventually get realized. And that is what actually has worked for us. We continue to go by that philosophy in terms of the value driven. So valuations we are very much cognizant of the valuations. That is the point, I want to drive. Second is that from a risk perspective, also manage our risk, within the framework of the AMC itself, in individual scheme wise as well. So here, and some of the new age companies which have been, so we are trying and participating in, new age companies, but it's not a blanket participation across the board without any valuation framework. So there is a valuation framework. Wherever we are not comfortable, we've not participated in some of the IPOs, which were very expensive and 100% say, PE exits, as you were earlier quoting. Probably some of the IPOs we haven't participated. So valuation, business opportunity, and management capability. I think those are the 3-4 important things that we would look at in terms of participation. Now, as of now, if you look at the fund positioning, so we are in terms of, if you look at top 5, 6, or top 10. So we have actually increased the allocation to large caps recently with the kind of valuation in the small cap and mid cap segment, which is gone far, have been reaching fair valuation or even beyond fair valuation to some extent. So as of now, if you see our large cap mix in the portfolio is almost like a 70% is large cap. Small caps is 12%, which used to be 20%. Probably, if you ask me 3-4 months back, it would have been in the range of 18 to 20% small cap exposure. So that exposure, we are cognizant about it, and we've increased it to large caps. If you look at mid caps would be close to 16%. So by and large, almost 70%, 16%, and then 14%, 12 to 13% is a mid cap, small cap. So that is how we are looking at it. In terms of international, obviously, some of the opportunity itself in the Indian stocks was far better, which is why, international, we kept it at 5%. Probably as we see, some value emerging in the international stocks, probably we'll try and increase that. But the idea is that we would like to keep it between 10 to 12% maximum from an international investment perspective. So, that is how it would be. In terms of the outlook over the next, from year on itself. So I think, as of now, still the demand visibility. So we have seen, the attrition for the industry going up significantly in the IT sector. That talks about that there is so much of demand from the client side, which is why, your supply side is getting challenged, and, there is a high attrition. Some of the, salary levels are going up by 30%, 40% in the industry itself. So there will be some amount of squeeze in terms of the margin. But I think this time around, after almost 10 years, I've been looking at, IT sector for almost like 17 years. After, more than 10 years, we are seeing first time that clients are, actually IT companies are able to see some increase and get increases in the pricing. Usually IT sector has been the price taker by the global clients. First time, so there is a strength in the demand, and companies which are able to execute and have the talent, I think they are able to get that pricing increases, which is the most potent factor. And till the time, even for going into next year, a year later, I think the outlook and visibility is fairly strong. So the big upside in the stocks have happened. The valuations which used to, some of the large cap companies were trading at 16 to 18 times forward price to earnings multiple. They've got re-rated to almost like 27, 28 times. Some of the mid-cap companies which are 14, 15x, they've got re-rated to 30, 35 times. So the big PE re-rating has happened. So growth-led or earnings-led, upsides will happen. But the kind of return that we've seen may not necessarily be similar, okay, in terms of the big re-rating. But still, the outlook is fairly positive from a growth standpoint. And to that extent, I think valuation, we do think that, valuations can sustain. I was highlighting that, in 2000 post.com, always we've seen that, that the sector was written off by and large, right? That, ho gaya, best time is over, period is gone. But point and again, be it 2008, again, everyone said that, IT business, GFC crisis, banking being largest vertical, kuch nahi ho. This sector has always come back after the big events in terms of the big triggers at the global level. We've seen next few years after those kind of events, the growth has actually increased. Outsourcing has increased, because today also, if you look at some of the Indian companies, the cost arbitrage between an offsite, as in offshore salaries, versus a salary in the US and the other global major markets, is fairly high. It's like 6 to 7 times the current Indian salaries, right? So which is why, there is a good value proposition that Indian companies provide, and hence, I think, this can sustain.
So in that case, Kunal, do you feel that this IT as a sector or digital as a sector could become the next big stable sector, providing lots of variety and lots of options within its own segment?
No, that's I think a good question. So if you look at from so far, the investable opportunity in technology was only IT services, which used to cater to the global clients, global markets. Now it's the time where basically we get the opportunity to invest in companies which are catering to Indian consumers. And hence, there is going to be a big shift. So one is that, that global IT services is continuing to grow, that is continuing to do well. Additionally, we have opportunity to invest in new age companies and new listings, etc., which were part of the private market investors, but now it's going to become public, and that is what we are going to participate. So something that, we were, actually experiencing, buying, same things we are going to be able to invest in. And this digital economy is a big economy. I think with, so Zomato as of now is a $16 billion market cap. Look at Paytm, also 12 to $14 billion, $14 billion kind of a market cap. Nykaa, which is again a 1 lakh crore plus market cap. You look at Policy Bazaar. So all these are big. I think at an index level, you will see, this new age overall getting into various indices. And from a benchmark perspective, I think, the weightage is only going to increase dramatically. So maybe after 5-7 years, probably, you could see one of the major as a IT slash technology slash IT as a big, index in the benchmarks itself. So that will certainly happen.
So if we look at the way traditional businesses used to work, largely it was more of a brick and mortar type of say companies that used to actually grow in size. But new age companies, if you look at these new age companies, one, they grow pretty fast. They are very agile. But sustainability could be one big question that everybody would be having in their mind, because the run happens so fast. So how do you actually look at this space in terms of sustainability?
Sustainability, sure. No, so certainly, I think, there are many companies coming up. Everyone, and these are at early stage or slightly higher, slightly ahead in terms of the stage of evolution of the market. So definitely, not all these companies will succeed. It is important to keep on tracking it quarter after quarter, seeing the strategy movements as in, in terms of business decisions, etc. So you have to track all these KPIs, etc. very closely. Not everything is going to succeed, because, if I were to take an example of, one of the research projects that I had done in say 2010 was on the internet sector. 2011, I had released a very big report on it. That time I was with the other organization. So that time I had, that time there was one company called, Snapdeal was one of the, large e-commerce. So they had, that time it was Groupon was one of the companies in the US, which was fastest to reach $1 billion, which was like, I think in 2 years, they reached $1 billion of revenue. Snapdeal, similarly, they started with a discounted coupon-led model, and they were scaling up 1.5 years, they scaled up very fast. If you look at now Snapdeal, it's in a very different shape and form. So starting from a purely discount coupon-led model, they went to commerce model. And now, as of now, if you see, they have gone through their challenges. It was on the verge. There is a good case studies available online on Snapdeal itself. You can see, actually it was on the verge of bankruptcy and about to, get shut, etc. But, founders fought, they did, convinced the investors to continue investing. And they've last 3-4 years, if you see, they have come back nicely in a different, in a more focused approach. So they focus only on now, on the fashion BPC segment and the home segment. So, bed sheets and all those online in terms of, so their focus segment has reduced. They are profitable at a contribution level. So companies, you have to see the companies in terms of, so companies will go down, companies will come back also. And I think, that is something that is going to be very important. Not everything is going to succeed. Some of the companies, so one of the earlier ones, if I were to talk about earlier, Rediff, Yahoo, these were the examples that, they were very early. They had a good audience. They had a good viewership. Rediff, one of the early ones in, during the 2000 timeframe. What happened to them? They are nowhere. Yahoo also, right? So as a strategy, you have to track the strategy very well and incremental basis so there is no clear way to say that, okay, ye 5 saal baad ye company success hai, 10 saal baad. Today's leader can be, tomorrow it will be, today they are disrupting, tomorrow they will get disrupted. So it is important to keep on tracking that. And, if, they are able to navigate through, you will see they emerge as winners across segment, as in across their own business segment. So that is how it will have to be.
Thanks, Kunal. So Sunana, one different question just to ask you. How do you look at technology companies, newest technology companies, when suppose they come to you for borrowing, or if they issue some bit of bonds, how do you all look at technology companies in terms of lending?
Manish bhai, technology companies are flush with liquidity, chased by all the fund managers and all the PE guys. So it's very rare that you get to see them. The pure tech companies come and borrow. Most of them are equity funded. What we do see, however, on a more serious note, are some of the fintechs, who do come to us, and we have invested in some of them in the past. I don't know if you remember seeing Lending Card in our portfolio, but that was a fintech, a very early fintech that had an algo-based model. And then there was Home Credit also, which had an algo-based model that determined their lending. But so we have seen some amount of a couple of these finance lending fintechs who have come to us, but these guys right now are a little more digital, if I could call it. They have physical presence. As well as they have, for their, at least the initial credit clearance, a fair amount of it goes through algos. But I think as we progress and as, a lot of this buy now, pay later picks up, and as a lot of fintech companies get into the lending space, we will see more and more of them actually approaching the debt markets. And we look forward to that. But we've already done a little bit of lending in that space, and it's been a good experience so far.
Any last note that you all want to share?
So just quickly, I'll talk about one of the things that from an equity perspective, I think India is at a good juncture in terms of mix of structurally as well as cyclically. So structurally, we've seen some of the factors which are supportive factors in terms of the government spending, ease of the policy stance, reforms on the manufacturing, infrastructure, financial, social side. So there is a good, cyclical recovery as well as combined with the structural factors, which actually put in a good spot for, upside over the next 2 to 3 and probably 3 to 4 year kind of a upcycle in terms of the business itself. So markets will go through their own, ups and downs, but, more important is that from a trend perspective, I think we are at a good juncture. And, obviously, during these times is when, market also, as in participating in the market benefits. And I think, that is how I would look at it positive from your own as well.
Thank you, Surendra. Thank you, Kunal. I think it was wonderful chatting with you all, and it was very insightful as well. I think we have covered most of the questions also, which our participants had asked. So thank you both.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।